Nvidia's powerhouse earnings has made the market even more concentrated, but at least one fund manager is looking for the names overlooked and underperforming. Lukasz Tomicki joins us, founder and managing partner, LRT Capital Management. Welcome back, Lukasz. So how's your approach kind of changing now as we see this hyper market concentration?
Well, good morning, and thanks for having me, Oliver. We are looking for names that we believe are good fundamental businesses, but for whatever reason, they're having short-term execution challenges. And in many cases, the stocks are at multi-year lows, and there's a lot of pessimism surrounding the names. And so in that case, there's a lot of opportunity for upside if the business continues to execute, and we believe the core business continues to be good, but sentiment changes around.
Okay, so when you look at the way these other sectors have been left behind, like Nvidia at one point was the entire market cap of the Chinese market. It's totally overwhelmed the size of many of our own sectors. Is the game to kind of wait until that money flows elsewhere, or might we be just seeing that over time we should be allocating away from the stuff that's not highly innovative? I mean, how much of this is like speculative bubble? How much of it is just real following the disruption, following the innovation?
Well, so I think you have to remember that innovation, broadly speaking, is not an investor's friend. So there's many companies and many businesses that have innovated, but have actually failed to create value for shareholders. And if we think about things like the internet, clearly the internet has changed how we do business, had a huge impact. But since 2000, if you bought stocks during the dot-com bubble, many of them went to zero. And in many cases, you're still below the peak they established in 2000. So simply because there's innovation that changes the world, that doesn't mean you will benefit as an investor. Right now, Nvidia looks invincible, and we like the company. There's a lot to like about it fundamentally, but it's less certain to us that it's going to be the ultimate winner and that you should put all your money into it. That's why we think you should look at some other names that have been slightly overlooked and are down for various reasons, which we believe are temporary and can turn around.
Want to get to a few specific stocks that are near lows that you're interested in buying, but one group that's kind of somewhere in the middle is in that energy category. What's your approach in looking at this as crude oil seems to be pretty comfy in this mid-70s level?
We like energy, and we have several energy holdings in our strategies. We prefer large integrated oil plays as well as independent refiners in the United States. And we like those because there are substantial barriers to entry. No one is really building new refineries. And typically, because the political environment is really against oil and gas today, it's very unlikely to be a lot of new competition. And at the same time, the market is valuing these names very cheaply. So even at the current oil price, they're making plenty of money, rewarding shareholders with buybacks and dividends, while valuations remain low. And we don't know when sentiment will turn around, but we're quite happy to own the names as it is right now. And we're slightly overweight energy relative to market benchmarks.
Okay. All right. A few stocks that have gotten really beat up that you're taking a chance on. Let's talk Charter first. After a huge crash going into and through its earnings, it seems like this is a communication business dealing with disruption from competitors and shifts in styles. What do you find compelling about it?
So Charter is the second largest cable company in the United States. They own some irreplaceable assets, really assets that are very difficult to replicate. They're only second to Comcast. And over the last 5-6 years, Charter has been a story of a shift from paid TV towards internet service. And more of Charter's business is really about internet service. Now, Charter recently lost some broadband subscribers, which was unexpected. And this is really one of the main reasons we believe the stock is down as much as it is. There's competition from what's called fixed wireless access. So basically 5G access through broadband. and there's competition from some fiber optic overbuilds. But ultimately, we don't believe this is going to impact, the entire footprint of Charter, and the stock is simply too cheap to ignore at the current valuation. It's at a 5-year low, and we think the amount of users is going to grow over time, despite the short-term losses they've had.
So has the general kind of disruptive force of internet TV maybe kind of run its course as we see a lot of these streaming businesses try to combine now? I mean, a lot of folks kind of joking that it's a return to sort of an old cable style. I mean, it's not really, but it might suggest that perhaps some of their potential has been fully realized.
Yes. So actually, for Charter as well as for Comcast, being serving broadband internet to consumers is actually a much better business than serving paid TV, because you have to understand, if you're paying $100 for your paid TV package to Spectrum, which is the Charter brand that they use, or to Comcast, a lot of that $100 goes to the networks as part of affiliate fees for the programming. So actually not that much falls to the bottom line of the cable companies. Now, on the other side, if they're selling you broadband access, they're keeping the entirety of those revenues. So the revenue perspective and the profit perspective is much better for the broadband business. And that's why we're really bullish on Charter as we are on Comcast.
Okay. All right. Charter, Comcast, also in the communications category, but from the real estate side, you like CCI, Crown Castle with the towers and the fiber trade. One I want to do a hit, though, before I let you go, is INMD, INMD, an Israeli-based business in the medical and healthcare category that's flirting with lows right now, Lukasz.
Yeah, so InMode makes minimally invasive aesthetic devices. They sell to doctors and med spas. It's about a 1.8 billion market cap, has no debt, 700 million or so of net cash, and the valuation is at a historic low. Now, this is an Israeli-based company, so I think there's some concern about what's happening in the Middle East from a geopolitical perspective. But more importantly, there's been a very substantial slowdown in the sales. And there's a publicly traded competitor, ticker Skin, which is at all-time lows as well, and they're experiencing the same slowdown. Part of what's happening is that these devices are quite expensive, and they're often leased to doctors. And obviously, as interest rates go up, credit standards tighten and leasing costs go up. But I don't believe beauty as a category in medical aesthetics are going away. We are living in an age where people are having fewer children, they're getting married later, they're trying to look better into older age, and we have Instagram where everyone's trying to look better. I mean, just look at me. I'm clearly overdue for some micro needling or whatever. So that thing is going to continue to grow. And I think as we get through this short-term, sales slump and sales stagnation, this is one of the best positioned companies with the best patent portfolio, an established network of sales of devices that are already embedded in doctors' offices. So doctors are familiar with these devices, and the valuation is really, really compelling.
All right. Lukasz, thanks for the details. Always like the stock deep dive. Appreciate it. I don't think you need any micro needling. I don't even know what that is, but appreciate the thoughts. All right. Lukasz Tomicki, founder and managing partner, LRT Capital Management.